Good morning to all of you, and I will be leading you throughout the day as your moderator, and it's a pleasure to introduce Beatriz Alonso Marjaganzas, at BME Exchanges.
Thank you very much. Thank you very much. So thank you very much, Reinhard. Dear colleagues of FESE, ladies and gentlemen, it is an honor and a pleasure to welcome all of you to the Bilbao Stock Exchange on behalf of BME and, of course, on my own. The title chosen for the inaugural conference dedicated to analyzing the future of the Capital Market Union couldn't be more appropriate. The Capital Markets Union Action Plan sets ambitious goals to enhance integration and efficiency within the European Union's financial markets. It addresses central issues such as providing access to equity for SMEs, creating safer markets for individuals to invest in the long term, and integrating fragmented markets into a genuine single one. The aim is to establish the preconditions for ensuring the long-term financing of European industry in all its forms, and to support major European projects, particularly in the areas of digitalization and sustainability. Financial market infrastructures play a pivotal role in the efficient and robust functioning of capital markets and in accelerating their development. By strengthening the FMIs, the European Union can bolster investor confidence, promote liquidity, increase transparency, and reduce risk within these capital markets. Global capital is required to raise the funds necessary to implement the European Union's main challenge, that is, to ensure the maintenance of the welfare state as we know it today. And for this, it is key to address the needs of all market participants, and especially small and medium-sized enterprises who are the protagonists of the sessions today in Bilbao. Simplifying capital access, improving transparency, and reducing administrative burdens will improve the processes to funding and encourage cross-border investment. In addition to the aforementioned investment by institutional and retail investors in Europe, global capital is required to raise the funds necessary to implement the European Union's major projects in the area of digitalization and sustainability. Only well-functioning European-wide capital markets, including the UK and Switzerland, along with attractive long-term projects, can ensure this influx. To accomplish the CMU's ambitious goal of creating advanced capital markets, it is important to focus on strengthening FMIs and implementing comprehensive reforms. Legislators and regulators need to embrace necessary changes and facilitate regulatory harmonization, streamline procedures, and alignment of local and national rules that are essential steps to foster the development of the CMU. I am really looking forward to hearing the views of the following participants and panelists and their suggestions for moving forward on this great European goal ambition. First, we will have the intervention of Peter Koblitz, President of FESE, Chair and CEO of Prague Stock Exchange, Jesus González, Head of BME Grow, and Tatiana Panova, Head of Capital Markets Union at DG FISMA. After those interesting participations, the first panel with the title How to Strengthen the Competitiveness of the European Union Listing Regime will be a fantastic opportunity to compare the US and European Union primary markets. Afterwards, we are having a second panel under the name of Unlocking the Potential of European Investment for the Real Economy, focused on pushing the participation of the retail investors. In short, a technical and very complete day on a subject that concerns all of us and in which we must work in a coordinated manner. I finally take this opportunity to wish you all a pleasant stay in this specific and special city of Bilbao, and that the activities and presentations that have been prepared will be useful and inspiring for all of us. I now give the floor to Peter Koblitz, please. Thank you very much.
Thank you, Beatrice, and well, welcome to everybody in the morning. It's a beautiful place, actually. You know, both buildings we were visiting so far, the Borza and the club yesterday, incredibly nice. So thank you very much, BME, for beautiful hospitality. Title of our conference is Quo Vadis, CMU. Yes, well, Quo Vadis. We have We are in the end of legislative period of 5 years. There have been many things achieved during this period, but there are a lot of things to do in the following 5 years. I think you have to be carefully thought through what are going to be the strategies, what are going to be the targets of European legislators. We are going through the challenging times, obviously, with the macroeconomic landscape. High inflation is eroding the market. Rising interest rates are hitting individual private investors. So it is not a good time for deep changes, but unfortunately, that's the time we have, and we have to do that. Also, around us in Europe, there are basically, or around Europe, there are basically 2 wars going on, which also doesn't help the overall situation. Those challenges are simply there, and there is no silver bullet we can use now to solve all the problems on capital markets. And I believe there are going to be a lot of the discussions what we do on a pan-European level. And I would like to use the opportunity here as far as the SME week. So I will a little bit rephrase that to not to small and medium enterprises, but to small and medium markets. Many times we see that the legislation and the markets are compared, for example, with the United States. We usually focus on Western European markets, which are being considered as developed markets. But there are some other markets where there is 120 million people, especially in Central Eastern Europe, which are sometimes I feel a little bit forgotten. They are not underdeveloped because they are on the same legislation level, I would say system quality level as the other markets, but they are definitely shallower, not so wide. Maybe there is important one single letter which is many times forgotten because usually we use acronym CMU. It is Capital Markets Union. There is a plural in the second word, which surprised a lot of the people actually, because a lot of the people think it's a capital market union, that we are making one market and like move everything to this one market somewhere sitting in the center. No, it is not like this. We have to first deliver the quality to the smaller markets, because we are not United States, we are not federal state. You know, the United States would not be a bad option, you know, so let's make United States of Europe, but we are simply not there. We are somewhere in the middle of the way. And those small markets simply so far suffer with the situation where they are open to the competition, very liberal, and on the other hand, not so deep. If we cannot really go so far to this United States situation because we are still 27 countries. We have 27 accounting rules. We have 27 securities law. We have 27 insolvency regimes, and I could go on and on and on. But paradox is that what is the least problem, I would say, is the 20 languages spoken in the European Union. We somehow all agreed that the lingua franca for capital markets is going to be English without the decision of the European Parliament. You know, now we need the European Parliament and the European Commission maybe to decide on the things which I was speaking about before, the securities laws, unification, and accounting rules, and so on and so on. So why, some people would ask, you know, why those markets would not develop the same way as markets in Belgium or Denmark develop over the years, that they would develop to the bigger markets. Well, there was a little bit different situation in the time when, if I take Belgium and Denmark was developed in the 60s and 70s. It was prior to MiFID. It was prior to the liberalization of the market. There was a time of the national champions. There was a time when was a concentration rules in those countries. So they had a time in a splendid isolation to deliver and develop the markets with the ecosystem, with big national companies. And basically, quietly, they build them, and then they start to merge together as a strong markets with the strong markets and start to compete with each other. We have a different situation in Central Eastern Europe. Unfortunately, we are incredible victim of the cherry picking. If there is a bigger company in Central Eastern Europe, it's immediately advised by the international, usually US banks, oh, don't list locally. because this is too small market. You should go outside. And if there is a small company, then it's us who have to work for funny fees, because from the small companies you don't get so big fees. So this is how the markets are working. And then we hear, well, you have to first grow the markets. Well, how we should grow them if all the big companies are, or almost all are, taken outside? There were great companies in Central Eastern Europe. If I name like UiPath, Romanian company, listed in New York, $40 billion market cap. Avast, Czech antivirus company, 12 billion, I believe, pounds, listed in London. By the way, already delisted. And you know, those we miss on our market, because those would be important to deepen liquidity and an investment pool on the markets. Does it have an easy solution? No, it probably does not. But I don't bring the solution for that. But we have to always keep in mind that this problem is there once the markets, the smaller markets, are criticized that they are too small and shallow and narrow. What we have to do is, once we are thinking about any kind of future legislation, we have to always keep in mind that those markets exist, that there is a market in Bratislava, as I see Lucas over there. There is a market in Sofia, there is a market in Czech Republic, and what will happen with this legislation, which might be thought, you know, very well working for competition of Frankfurt and Paris against New York, but should be could be harmful for development of the smaller markets. I'm not saying that it's always like that, but it often is. Actually, countries in the CEE are net exporters of the capital, at least the ones which are in so-called Visegrad 4. You know, we are relatively rich countries. You know, we have rich citizens. And as far as they don't have domestic capital markets, what they are buying US stocks. So the situation is that we are exporting capital to the United States from the countries which are considered a little bit poorer, and they would need more capital. If somebody asked me, oh, Czech Republic, you know, they would need more capital for development, I was like, no, we have tons of capital. It's sitting partly on our current accounts, and we will speak about retail investment strategy on the second panel. I think it's very important. So it's sitting on the current accounts with the banks, or we are exporting this capital outside because the rich Czechs are buying, you know, international stocks, mostly US, as I said. So the problem is how to keep this money in the region, in Europe, but in the region as well. As you see, my speech is a little bit less FESE and more on the Central and Eastern European. Well, I was sitting on the board of 4 exchanges in Central Eastern Europe. Now I'm sitting in 2, Prague and Vienna. I've been a board member in Budapest and in Ljubljana in past, so I have some experience, I believe. But now, one disclaimer. This is what I'm going to say now. It's definitely not opinion of FESE. We have to discuss it. One of the problems is a market classification by index providers. You know, index providers are living in 70s. If there is no change in the market classification system of the index providers, countries in CEE would never graduate to be pari passu, you know, with the Western European markets. Countries like Slovenia have no chance to organically grow from their frontier market status to developed market, even if they have a GDP twice high as Switzerland. Because there are some quantitative criteria they can never trespass, and you know, the market is too small for that. So there need to be change. There need to be pressure to change those rules. Maybe to tell index companies we are one country in Europe, investment-wise, and should be labeled as a developed market as total. So there are many challenges, but I think there is a way out. And today we will speak, for example, about the Listing Act. And I think Listing Act is a great thing. We heard yesterday from Bonifacio that, you know, they're going to be much easier to list securities. I would love to see that. I'm a little bit doubtful, because if it's a little bit easier from the Listing Act, you know, it's going to be much more difficult if you consider all the ESG requirements. But let's hope that's going to be really easier, because that would make actually access to the market cheaper, and that would help also the smaller markets, because the cost to get to the markets are usually the fixed cost. The size of the cost is usually not proportional to the small cap companies. And this is very good point to start with. And second thing, the retail investment strategy I was already speaking about. You know, I think there is untapped potential of investment-ready funds in Europe, and specifically in the CE countries where we have the problem that the money is lying on the current accounts and on the term deposits. So I hope the discussion is going to be fruitful. I hope that at least some of what is going to be said and advised today going to be reflected in a legislation process over the next 5 years with the new parliament. We will definitely in FESE try to do the best to help European Commission to tailor-made more those important rules for the big ones and the small ones, to consider that we have both in Europe, and to build a capital markets union eventually. With that, I would like to hand over to our Director General, Master of Ceremonies of today, Rainer Ries. Please, Rainer.
Well, thank you very much, Peter. And actually, it's my pleasure to announce the keynote by Jesus González Nieto Marquez, the head of BME Growth Markets. And I think also very topical to speak about the growth markets here in Spain. Jesus.
Thank you, Rainer. Good morning, dear friends, and thank you all for being available today. Obviously, thank you also for FESE to have the consideration to invite me to address some words this morning as I would say an introduction to the panels we're going to enjoy today. Let me share some thoughts about the circumstances that had allowed the capital markets to find a new way to approach SME financing, because still there is a belief that stock exchanges are only for big blue chips. It's quite common, and for many current participants in the capital markets, it's something that it is stated as a truth. And probably they were right some 20 years ago, because some previous attempts to tap the financing in capital markets for small and young companies it didn't succeed in the 90s or even in the beginning of the 2000. So obviously many of you recall some attempts like the Nouveau Marché or Second Marché or the newer market, and in Spain again, the Segundo Mercado, Nuevo Mercado. That was not a success, but 20 years later, the landscape is a bit different, and now I think we can enjoy not sufficient, but a broad range of markets specifically addressed to SMEs. In fact, almost stock market group in Europe has one of those SME markets, and obviously we compete each other to attract new companies. And what has made the difference in these 2 decades? In my opinion, the stock exchanges have been able to take advantage of some changes in the strategy of certain participants in the capital markets. That's the key, because for the first time ever, particularly from 2000 to 2020, investing in SMEs has started to be attractive to some kind of investors, venture capitalists and investors. Angel investors has developed very significantly. We lag behind, obviously, we compare it with the United States, but has developed in the European Union. Also, some crowdfunding platforms started to become popular among certain kind of retail investors that additionally started to be keen on startups that show some innovations, technology-driven, so on. And at the same time, a number of middle market, I would say middle market banks or brokers have shown interest in bringing together those companies and those investors. It's clear that none of those middle market banks belongs to the top leagues. Big names are not active in this field. The structures simply do not allow them to pay attention to this segment. Also, a scarce number, but at least some of the research houses have taken advantage too of their specialization in small and mid caps, not to say some legal firms, public relation and investor relation consultants, audit firms. So little by little, a small ecosystem for the first time ever, have started to become a little success in a number of companies. Let me stop a minute in the case of Spain, because I know it before, but obviously many very similar stories can be told of other stock exchanges. Maybe you are more familiar now. To be true, in Spain we arrived a bit late, some 5 to 10 years late to this tendency, but in spite of that, since 2008, when the Spanish Stock Market Commission give us or grant us the authorization for launching this SME market, the stock exchanges in Spain, BME Group, developed a multilateral system now called BME Growth, as almost every market in Europe with the surname Growth, in which, well, 140 companies are traded today with, we calculate, more than 200 institutional investors taking part quite constantly currently in this several small, mid, or micro caps, and also obviously some investment banks interacting with them. The beginnings were, you can imagine, quite hard. It always is hard. It took 5 years to make up the first 20 companies. At that time, unfortunately, we faced a reputational scandal in one of the main companies listing that makes some participants to think that that was the beginning of the end and the market should close. Fortunately, many others remained confident, and we managed to overcome the crisis and to reinforce rules on audit and governance mainly. And by 10 years after, by 2018, we reached 100 companies. And finally, we can say that over 170 companies have benefited from this market. Anyway, the main challenge for us, and I think for every SME market, is to find enough investors. That's the key. It's an ongoing challenge, and we still consider it today the most difficult task. To do so, finding, and fortunately we share, and some of them are present today, and have to thank them, some specialized brokers or small investment banks is completely essential. As I mentioned before, you will not find them in the big leagues. 3 or 4 middle names were enough to start in our case, and they are completely essential to find the right companies for the right investors and produce also some research in spite of the MiFID regulations to help to improve the liquidity of a market that basically is made of stocks that by their nature are not liquid. Of course, you need some success. Successful companies' case may speed up the process and attract the attention of many other companies and investors. And on the contrary, a scandal may put the whole market in danger. So, or even simply a big proportion of disappointing transactions. What I can say is that if that happens, the coordinated action from all the ecosystem, I mean, first the regulator, the market itself, the market participants, is essential to survive. Also, and we have some representatives here, to enjoy the support or the attention of a specialized media is paramount. Media can help in disseminating the information to make the investors aware of the development of the market to support small companies in their way out to the IPO, etc. And if there is a real political interest in that, any kind of support from public institutions, it is a very valuable help. Not only because, I would say not mainly because the financial impact that it means for certain companies or certain investors, but for the confidence that may show in the process in investing in SMEs through a market, instead of buying T-bills or just having the money into the bank account. In Spain, we were not so lucky as the British or French or Italian cases, and we don't have really a tax relief, with some exceptions, to be true, in some local regional governments. But even a small budget for public loans to finance the IPO costs for an SMEs that we enjoy at the very beginning from the Ministry of Industry in Spain, it helps a lot. So let me end with two more reflections on what do we need now in Europe to develop SME markets. I do insist, SME markets need investors, specialized investors. Probably no more than ever in the context of rising interest rates and growth stocks out of the favor of conventional equity investors. Finding specialized investors is critical. If we want our SMEs to grow up in Europe, to be bigger and more competitive, we need to specialize the investment in this kind of companies. So a good way to do that is co-investing from public institutions. That will be a big help to build up a wider investor base. For example, the EIB initiative to help funding the what we call the crossover funds is a very good step in the right direction. But in my opinion, new or old, I don't know, but investment vehicles offered to retail investors would also be essential to give those investors, we are talking about that later on in one of the panels, to give those investors access, because they're simply not prepared to manage a direct portfolio for themselves in SMEs. But at the same time, remember that in many countries of the European Union, retail investors are not allowed to invest in venture capital or private equity funds directly. So it's only in other closed-end instruments. So if we want money for these companies and we want vehicles, it is nonsense to ban the investors to put their money into vehicles. Tax incentive for the investors who dare to put the money into innovative, by other way, risky entrepreneurs, instead of buying public bonds. It is absolutely key to show the way to follow. It is not a question of giving a big tax relief. It's just a question of put a signal. If you do that, you are going to help us in the right way. Many of the regulatory changes included in the Listing Act initiative, we will be reviewing in a minute, will make the SME life in the public markets a little bit easier. I myself have the privilege to take part of the technical expert stakeholder group on SMEs stated by the European Commission. And a number of the recommendations of the group are now presumably about to become a formal regulation, but in my opinion, deeper and more ambitious regulations or deregulations maybe is the key, to deregulate a little bit, are needed if European SME markets are to be a real support for the growth of smaller companies in our continent. So I really hope that the coming panels this morning may help us a little bit in thinking how to follow the right way. So thank you very much, and thank you for your patience.
Thank you very much, Jesus, and I think you very nicely outlined, and Peter, I think, sort of said similar things from the Eastern European perspective, that I think there is the challenge on how to really get investors mobilized to come into European equities, especially in the SME segments in the growth markets. And you outlined the opportunities of deregulation, and I think what is going to happen with the Listing Act. We'll probably hear about that now from Tatiana. We are welcoming Tatiana Panova, who's going to give us a keynote speech on the Capital Markets Union, and especially, I think, the state of the Listing Act. Welcome, Tatiana. This will be.
Thank you very much. I hope you can hear me.
Yes, we can hear you. Not yet
Very
see
well.
you. 1 second. Now.
Okay.
Hi,
Oh,
Tatiana.
I'm very big. I can see myself. All right. Well, good morning, ladies and gentlemen. Unfortunately, I cannot be there with you in Bilbao, but I'm very happy to address you, at least digitally, and particular thanks to FESE and to Rainer for inviting me. So maybe a few words on where we are today and what we went through to set the scene. The EU public markets, as we know, had a very bad 2022. And then not even out of COVID, we had a geopolitical turbulence that shattered the sentiment and made companies quite wary of public listings. I think many deterred their decision to list and to raise any funds through capital markets. 2023 was slightly better. I think in terms of debt, we had a fairly good year, actually quite exceptional if you look at the first quarter, where apparently companies raised around $1 trillion from capital markets, and that is the highest number since 2000. So that is quite remarkable. But in terms of equity, I think markets really struggled to pick up. And there was some short-lived rally, I think, at the very beginning of 2023. But then primary markets remained fairly flat. And I think overall, looking at averages, we see that they're at least 20% below the 5-year average. So we're not there yet. So where are we exactly with listings? By September this year, we had roughly 60 or 61 IPOs in Europe, and out of which 57 were from the EU companies, so not from non-EU, but EU companies. Quite remarkably, and I think Hazel's talked about SME listings and IPOs, 82% of those IPOs were by SMEs, so who raised around 6 billion euros. That's quite remarkable. IPOs were characterized by some degree of concentration, so most were in Italy, quite remarkably, 25 out of 61, with 21 being done by SMEs. Then followed by Poland with 6, and then I think Spain and France 5 each. In comparison, in the US, 120 IPOs took place in the first 9 months. So this is about double of what we had in the year. If we take today as the reference point, we have around 140 IPOs, with about half of those on NASDAQ, and half of those on NASDAQ, interestingly, coming from outside the US. So companies outside the US, non-American companies raising funding on NASDAQ. In the EU, this corresponds, so listing by non-EU companies on EU markets corresponds to around 7%, not even. So I think there is no doubt that not only US attracts in general more IPOs, it does attract more IPOs from other jurisdictions. Non-EU listings on EU venues, unfortunately, remain rather exceptional. So I would say a clear scope for improvement or catching up to do in the EU. As you know, policymakers, we are concerned. Listings and public markets are very important to our economy and to our global competitiveness. Together with the co-legislators, and you've mentioned, I think all of you mentioned the Listing Act, we're trying to get the listing package past the finishing line. Crucially important, I would like to emphasize this, in a form and shape that would amount to true alleviation. At times, I have to admit, we're confronted with a certain rigidity of, for example, some supervisors who struggle to consider change in a context where, at least from their perspective, things are functioning quite well as they are. So unfortunately, this doesn't always marry well with the objective to agree on ambitious reform. Having said that, the general mood remains very constructive, and hopefully an agreement in trilogues, which, by the way, start next week in Strasbourg, so we're going. So we hope an agreement could soon be reached, and definitely, I would argue, before the parliamentary recess. If you allow me very briefly, as by now, and despite the fact that you said that I would focus on the listing package, actually I will not, but I would like, nonetheless, to maybe go very quickly through some of the most important elements of the proposal. And I'm not doing this because I think you know the proposal by heart now. So I think this is important to stay on the key aspects. So for me, the most important part of the proposal, the most, my personal top one, if I may, is the proposed exemption for secondary issuance for fungible securities. So that exemption alone, I would argue, should drive up the value of listing in the eyes of EU companies under EU rules. The ability to tap repeatedly the market with little to no excessive bureaucracy attached to it would undoubtedly be appreciated by companies, and in particular smaller companies who are struggling with compliance. More streamlined supervisory scrutiny and better predictability of outcomes when it comes to drawing up a prospectus should be another important contribution of the proposal, because I think, referring back to the public consultation that we conducted before drafting the proposal, supervisory scrutiny, always was mentioned as one of the top issues or obstacles that companies, issuers faced when considering listing. Alleviated requirements for disclosure of insider information, my top two, if I may, should lower the cost of compliance with the market abuse framework, focusing on the information that is truly relevant for the investor. Now, as you might have heard, alleviations in other areas, such as insider lists, were met with a great degree of skepticism, not least from the supervisory community, who argued that event-based insider lists are more relevant than permanent insider lists that we currently have for SME growth markets in their supervisory work. Now, the final element that I would like to mention, and that is going to be an important change, and Jesus mentioned in his speech, despite MiFID, we managed to have research. So another important change will concern investment research, precisely, where the Council decided to go even further and to be even more ambitious than the Commission proposal by agreeing to full rebundling. So far, so good. So let's see what the trilogues will bring, and we will know more next week. Now, are lower listing numbers entirely and exclusively due to high compliance costs? We have been quite open about it. Probably they're not. Compliance burden isn't important, but as frequently said, not the only or may not even be the decisive factor for a decision to list. As just seen, companies, also non-US companies, are even prepared to go with much stricter SEC rules and a high risk of litigation in a litigation-prone culture such as the US in order to dip into deeper and more liquid markets with a wider investor base. So the review of EU listing rules cannot be the only response to the problem. We need a comprehensive approach to solving the issues infesting public markets. And this is notwithstanding the challenges that we're confronted with, so never stopping and sometimes closer to home, sometimes less close to home, cataclysms. But all of them do affect markets because listings, like political stability, they're like growing markets, strong investor sentiment. And currently Europe, and to be honest, the world in general, is struggling with many of those elements. But somehow, some are struggling more than others. So what can we do? What makes the US so much more interesting than EU? There is one answer word to that: investors. And I think both Peter and Jesus mentioned investors. So Peter mentioned retail investment strategy. I think Jesus mentioned more in intermediation by brokers, but investor came out quite strongly in both presentations. So Europe needs indeed investors and investor demand. For an IPO to be successful, and by success I mean achieving the target valuations, you need, and this is not rocket science, on the one hand, companies in search of funding, and on the other side, investors willing to invest. Supply needs to meet demand, in other words, right? So we need investors willing to invest in primary markets, but also to trade in secondary markets to maintain liquidity in a stock. So the problem of Europe in this regard is that many companies are afraid of listing, also fearing delisting, because they are afraid of subdued trading in their stock. So if we solve this, we will solve the issue with listings. So what we need is healthy and robust liquidity in EU markets, liquidity that doesn't evaporate at a first sign of downturn. And for that, you need solid retail investment, both intermediated or not. Our problem is that EU investors don't really invest in EU markets. I usually say they don't do it for 3 reasons: because they don't have money, they don't understand, and fear that they, what they fear what they don't understand, and because they don't trust capital markets. In the EU, I would argue it's a combination of the second and the third conditions, as the level of deposits in the EU suggests that there is potential to invest, it's just not realized. The second reason, lack of knowledge, could also be curtailed, at least to an extent, if people truly trusted capital markets and with this professional intermediation. After all, you don't need to be a mechanic to drive a car, right? So the problem that we face, and this has been confirmed by the recent Eurobarometer study, is that only 38% of people who participated in the survey said that they're quite confident that the advice they receive is from financial intermediaries is primarily in their best interest. That means others don't. That's quite important. So with our retail strategy, we hope to address the issue of the lack of trust in retail investment, ensuring that products bring value to investors and that investors can invest and can compare products also in a new digitalized setting. It also seeks to address more recent risks, such as risks related to social media, influencers. This in particular concerns younger and more digitally savvy investors. Unfortunately, it is easier to lose trust than to gain it. Only many years later, we will be able to see whether our proposal was truly effective in rebuilding this trust. Now, I would like to add a 4th reason to my 3 reasons that I've mentioned before, which I don't often use, but I think is nonetheless quite important in behavioral economics. And this reason is that people also suffer from inertia. Increasingly, the concept of nudging investors is being talked about in this context. Provided trust is ensured and retail investors are adequately protected, we would also need to address the issue of inertia in retail investment. In this mandate, the Commission cautiously started to approach the question of occupational pensions. Such concepts as enrollment in occupational schemes with a possibility for employees to opt out increasingly get to the fore of policy reflections. Now, I would argue it is wrong to approach this issue from the capital markets point of view because this should not be the primary goal, right? The primary goal should be the welfare of individuals, their right to adequate quality of life at retirement, which unfortunately, let's be very frank about it, current national systems cannot guarantee. Today, many member states are struggling to finance their citizens' pensions. Guaranteeing a certain level of pensions in a situation where the fiscal space is non-existent is far from straightforward. Under these circumstances, capital markets and market-based pensions could actually be a response that policy makers are searching for. Not only will it solve one of the key burning social issues, but also as a byproduct, if I may, will drive the growth of intermediation in occupational and private pensions. Ultimately, we hope, spilling over into public markets, propping the EU investor demand and reinforcing liquidity in EU stocks. So something that we desperately need. This debate is, however, only at a very early stage. Undoubtedly, it will require strong political will, as the issue of pensions is very political, if not to say politicized. So we shall see how the new Commission will contribute to the debate during the next mandate. And with this, I would like to thank you all for the opportunity to speak in front of you today and wish you a very interesting conference. Thank you.
Well, thank you very much, Tatjana, and I wish you a lot of luck in the listing act, and I think getting the trilogues well over the finishing line, because as you heard in the morning, this is a very important piece. And the second piece you outlined, I think a lot of political ambition for the next mandate, probably especially for member states, a lot of political ambition to activate retail investment and institutional investment for European markets. So thank you very much for this. Bye-bye. And let's go on with our first panel, how to strengthen the competitiveness of the EU listing regime. I would ask the panelists and our moderator, Rosa Armesto, the Deputy General of FESE, up here on stage, and I will announce briefly the panelists, so please come up. José Antonio Bareña, Director General of Gestión, Florence Bindel, the Secretary General of European Issuers, Aurélien Narmino, Head of Equity Listing of Euronext, and Francisco Vidal, Director of Economics and Sector Policies of CPIME.
I don't know. No, it works, yeah.
Okay. Perfect. And mine? Does it work? Yeah. Good morning, ladies and gentlemen. Well, I already, Rainer, introduced myself and already the panelists, but I will briefly also make a few comments on the people we have the luxury to have today with us. And I'm very pleased to be here today moderating this first panel in such an important topic in Bilbao, my home country, so I'm kind of double happier today than usual. And already we had an excellent introduction into this panel, having listened to the remarks from Tatiana Panova, Head of Unit of the Capital Markets Union in the Commission, the person that really is behind thinking through the ideas on how we can improve the situation. She put very good numbers, statistics. She set the scene quite well, so I don't want to repeat things because otherwise it sounds pretty negative, and I'm a rather optimistic person, but it's true that the situation that we have today deserves some reflections. So the panel will be on how to strengthen the competitiveness of the EU listing regime, and I am accompanied today by a very good set of panelists because I think we gather a mix of people that have more kind of the global European view, as will be the case for Florence and Aurélien, but also I'm very happy to have as well the view from kind of day-to-day local market practitioners, as it will be from Francisco and Jose Antonio. So I hope that all together we will be able to come up with good ideas, and that's something that we can then feed up to the Commission in the kind of discussions they are having for the next Commission mandate. Then, as I mean, everyone through the morning has been painting a rather, I will say, negative picture. European economy is headed for a slowdown currently. Market-based financing is more needed than ever. Supply-demand has been also mentioned this morning. Jesus said it. We need issuers, but we also need investors, that they really match. But how do they match? They match if there is a driver of liquidity. And this is something that already in the sessions we had yesterday, I heard that somehow is the missing piece. If you do not have the liquidity, then it's very difficult that you have issuers that think of going into the public markets, and equally you do not have the investors there. The Listing Act, clearly, together with the retail investment package, will be legislative measures that in principle are meant to alleviate and improve the situation, but I would like to discuss today precisely how we can increase the depth, the liquidity, and the valuations of companies in the European Union precisely that they stay in the continent. And why is that? We also heard that the US appears highly attractive for some of the issuers in some instances, and we really see that the EU is not faced anymore with the UK when it comes to competitiveness, is faced with the US. And this is a very important, I will say, argument that we have in the latest years. Then just to give a few data, even though, I mean, we already heard some data already in the morning, but there was a very interesting report published last week on the CMU KPIs by AFME, and FESE was also part of that report, among other associations, in which, first of all, they were saying, a good reminder, this year is the 30th anniversary of the single market in the European Union. And despite that, over the past 3 years, the European 27 member states only accounted for 7% of global IPOs compared worldwide. In fact, if we look at this first semester of 23, on equity, the situation is even worse than last year on the 22. According to the data from that report, IPOs issuance fell by 72%, which means that if the trend continues, we will be this year at very flat levels compared to 2011, when we were really exiting the economic crisis. So it is very clear that we are facing a big problem. I think everyone agrees into this, but we need to discuss how we can really deliver this true capital markets union, as you were saying, Peter, in plural, right? Also because there is a digital and a sustainable transition that will have to be funded precisely from money likely coming from capital markets. I will now finish then my introduction. I would like then to organize the panel in 3 rounds. First, I would like to take a stock of the listing package and see whether what the Commission has put forward is enough, is ambitious, on whether maybe some of the things I would like to get the views on, there is any sort of silver bullet on expected changes. Then I would like to do a second round in which we would likely zoom a little bit more into the dynamics, because I think it is very important also to understand the day-to-day of those that are helping assessing companies to go get financing, what are the difficulties and the benefits that they are getting. And the last round, if time allows, and I hope so, I would like to look into the future and see what great ideas the distinguished panelists will have to try to fit in the discussions of the next Commission mandate. So, we heard, and I will start with next to me, Aurélien Arminio, head of equity listing in Euronext, but also chair of the FESE listing task force. So Aurélien also collects the views of all exchanges in Europe on what is your assessment on the Commission latest proposal. In fact, Tatiana outlined 4 main alleviations that she believes will help. She mentioned, number 1, the exemption on secondary issuance, the disclosure information under the market abuse, so all the things that they have tried to alleviate there, insider list, but also the equity research, the coverage, which was something that yesterday in the SME assembly I heard many times from the companies. So what do you think about all that, Aurélien?
Thank you very much, Rosa. So we heard a very good introduction of Tanya, and I must say generally we are very supportive with the direction of the proposed legislative changes under the Listing Act. We think the Commission's proposal were ambitious in many respects, and we are pleased to see that, for example, the proposal on setting a uniform and standardized and simplified prospectus across Europe has achieved traction by passing pretty much as is in the various negotiations in Council and Parliament. There is one point, especially on the exemptions, which Tanya mentions as being very important to tap secondary markets, where we are a little bit concerned that the negotiations in Council and Parliament have watered down the initial Commission ambitions. So we will probably end up with a 2-tiered system on exemptions with 2 thresholds at 5 and 12 million at the discretion of member states. And we're particularly concerned with the potential to implement national disclosure regimes below those thresholds. And so we see this as a risk of further fragmentation of the market, which is contrary to the objective of a true capital markets union, where companies can tap capital across the union without border or administrative difficulties to do so. We are pleased that the Parliament has added some changes in the prospectus approval and scrutiny to ensure that NCAs do not ask for additional requirements above those set out in prospectus regulation. This is important for us. We're a true pan-European operator, and we are concerned with some actors picking and choosing regulatory places, regimes, and regulators that suit them most to compete out of one location in Europe, and we really want to nurture local markets, and so it's important for us that the application of regulation is done at a uniform level across Europe. If I move to from prospectus to the market abuse regime, which goes very much with the cost of compliance when companies are listed, we are happy to see that the Parliament supported the status quo of maintaining an event-based insider lists for issuers, which should limit the burden of maintaining those, and we would like to see further simplification of those lists. We're also pleased to see on the cross-market order book surveillance mechanism that is being implemented to see that the scope has been expanded to systematic internalizer. It is a reality today that systematic internalizers represent a sizable proportion of trading, and the risk of market abuse exists at the same level on those venues than on the regulated market. Last, maybe I would like to make a point on multiple voting rights, and we can also speak quickly about research. On multiple voting rights, we're very pleased to see that first, the EU is actually venturing into corporate law, which is a novelty, and we welcome the ambition to implement a uniform regime on this important competitiveness measure. We are pleased that the latest negotiations in Parliament have led to the support of an expansion of this provision to regulated markets, although The Commission's initial proposal was restricted to growth markets. We believe we need a European regime. We don't want intra-European competition on this point, which we see in our venues as being a force of attraction for certain listings in certain venues, and a real competitive situation against London and the US, which are our great competitors. What we would like to see, though, is that the safeguards remain in the hands of member states. We find it difficult to mandate at European level voting ratios or sunset clauses, and we prefer those to be adapted to the local situation. On research, I think as exchanges, we neither consume nor produce research, so we are not necessarily the best place to judge on what the economics of such a market should be for a more dynamic research market. However, we welcome the at least intention of the Commission to increase research on SMEs, which will be one of the drivers of liquidity. And we'll talk about liquidity with equity capital allocation to the market, etc. But research is a part of making investment more easy in those stocks. So.
Thank you so much, Aurélia, and indeed let's hope for the best in these trialogues that will kick off next week. And now I would like to turn to Florence Bindel. Florence, in your experience heading European issuers, do you think that some of those measures will have a positive impact, or what's your brief assessment on the listing package?
Thank you, Rosa. Thank you for the invitation. It's an interesting question given all the figures that we have heard, and the first time I presented the listing package that we really support, the question from the issuers is, how do you think the figures will evolve, you know? And it was like the question that is difficult to answer, but definitely we hope it will be, you know, have a positive impact, and we support completely the alleviations to the burdens for companies. It has been evidenced over time, so it's needed. The ambition is there, but probably it's work in progress and needs to be continued even further. Now, when it comes to the current state of play, we are, I would say, a little bit less confident on MAR and prospectus than we are on multiple voting share structures, so that they could deliver the full potential for corporates. From the perspective of the market abuse disclosure regime, which places, we think, a lot of disproportionate burdens, the simplifications are very much welcome. For instance, the disclosure of the inside information with the clarification of the final event, it's important. It needs really clarity. And also the fact that there are not intermediate steps, I would say, of the inside information being disclosed. I think the calculation method for the moment for the threshold for managers' transactions should be clarified. I mean, we have expressed this several times, and as it has been proposed, for the moment, it's not really included. On the reporting of the insider list, I mean, it's worth noting that there is an amount of data to report, but we think it's, to a certain extent, not proportionate or sometimes not even relevant, because it relates to information that is already known by the national competent authority. And then when it comes also to one of the aspects, it's most of the time the sanctions regime, try to have a proportionate approach, but proportionate approach taking into consideration the impact on the market integrity. And sometimes we don't see that happening in the proposals that are being discussed. Concerning prospectus, we think indeed that alleviations, are good to improve the effectiveness in terms of the framework and the exemptions. And I'm not going to go back on this. I think it's important to meet business and investors' needs. But what we think is to try to support more, I mean, we don't support the standardized sequence on the content or order of the presentation. We also don't think, I mean, we will come to that, but on sustainability and ESG topic, there is a lot on the table for the moment. So let's, keep this, and it's already disclosed under other legislation legislation, taxonomy, or CSRD. So we don't see why it should be asked further information. Also, it's important to look at material information to provide to investors so that they have real alleviation. A real alleviation meaning on the content of the prospectus that should be carefully defined where it's possible and streamlined to enhance the comprehensibility and readability, but rather than focusing on the page limitation. So on that aspect, we think maybe more on level 1 will be welcome. The threshold to benefit from exemption as the proposed, I mean, it was already mentioned by Aurélien. I mean, not as good necessarily for the reason he explained, and also the prioritization of the risk factors that is required. We don't really see the need for moving towards such a direction. Multiple voting share structure, and I'll finish with this. It's really key. It's something that we heard along the years, so very good. I think the proposal is there. Nevertheless, there are already some regime existing, so minimum organization, it's what we definitely support, irrespective of the trading venue as well. So we are very also pleased with this approach. Nevertheless, it's important to maintain this flexibility at the level also of the issuers. I mean, so that they can assess, you know, their own path in moving forward with this application of the multiple voting share structure. And also, we don't think that more stringent mandatory requirements that are, you know, being proposed or would act as limitation to the exercise of the multiple voting share structure should be implemented, because they would result in the lack of attractiveness for the issuers.
Thank you, Florent. So what I hear from you too is that, yes, there is a good intention from the Commission, but there's still room of improvement. So let's hope for the best during this final step of negotiations. Otherwise, it will be important, of course, to voice all these areas that will have to be rounded hopefully soon. Now we would like to move to Jose Antonio Barrena. You have a very broad experience in advising companies, Jose Antonio. So I know you are not in the details of the day-to-day Brussels legislation, but you do have a lot of experience on what are the realities that your companies face, the needs that they have. What are you telling them, and how, in the sense that, how do you think that this kind of battery of measures that the Commission, I will say in the best intention, has tried to put forward, will then play out in the future situation?
Okay, thank you, Rosa. Thank you to FESE, thank you, VME, thank you, Manu, for organizing this event here in Bolsa Bilbao. Just to be honest, when I received a phone call from VME and from FESE that they wanted to invite Norgestion, they wanted to invite us to take place in this panel, I was really surprised because, as Rosa was saying, I'm not an expert. I'm not an expert in all these technical issues, what's going on in Brussels, what's going on with this listing act, in order to improve, in order to, you know, to bring back companies to the stock market. My experience is as financial advisor. I have been working as a financial advisor for SMEs, Spanish companies, over the last 20 years. I've had the chance to work in more than 10 processes to, you know, helping companies to go public. And this is, I guess this is the main reason why I'm here, okay? So in my experience, and now the market is dry. I mean, when I say the market is dry, over the last couple of years, we haven't worked in any primary process to go public for an Spanish company. Okay, the market is not especially healthy right now due to the lack of investors. When I have the chance to speak to any Spanish company that they wanted to raise money, because the main motivation for a company to go public is raising money. In most of, at least this is my experience, okay? So we cannot forget that they have the opportunity to raise money in the public market, for example, going public to a Spanish alternative market, or they also have the opportunity to raise money from private sources, from private equity funds, okay? Over the last couple of years, the private equity market is still very healthy, when the public markets, they are not. So I think we are losing this battle. I have had the chance to work with more than 20 processes of private equity over the last couple of years, and none in the public market. The companies, when they ask Norgestion, okay, let me or tell me which is the advantages or the disadvantages to go public, in most of the cases, we can only speak about advantages. When you go public, I mean, you remain your independence in most of the cases. You get good prestige, good branding. You attract, to go public, you attract talent because your company is stronger, your company is more attractive to, to new executives, to new employees that they want to work with public companies because they're stronger than private companies. Also, I discovered, working in the public markets, I discovered that being public or going public is a huge instrument, is a huge tool for M&A purposes. You can merge companies, you can take over companies without cash expenditure. You can, I don't know how you say it in English, you can pay with your own shares. So my experience is very, in that sense, is very positive. Working in, as I said before, in more than 10 different processes to go public. But unfortunately, what I feel, or what I'm feeling over the last couple of years is that the market is I don't know why. I don't know why it's the reason. Probably, as Peter was saying before, maybe this is due to this macroeconomic environment. A high interest rate, high inflation rate. The environment, the financial environment is not especially strong due to we have 2 wars in Europe. But I don't think the situation in America is much better, okay? I'm not seeing a lot of IPO processes in America either. So let's say this is a global situation, and obviously we have to wait, we have to work, and I think what the European Commission is doing right now is absolutely necessary. But it's also very positive, trying to motivate investors coming back to the market, coming back to the stock exchange. Okay, how do you do it? Believe me, I don't know. Maybe we can work a little bit in tax benefits or tax incentives. We can work a little bit in helping institutional investors and retail investors in trust again in the market, and instead of investing their money in, I don't know, in real estate, in fixed bonds, or in any other kind of securities, taking the risk to put their money, or at least part of the money, in the equity capital market. Preparing this conference, I read the other day an article that really surprised me, and I read something, I don't know if this is right or not, this is what I read, okay? It was from a financial report saying that in America, any saver means somebody who saves money, retail investors, invest around 50% of their savings in the equity capital markets in America. In Europe, it's about 25-something%. I guess that in Spain, probably it will be lower. Probably this is a cultural issue, and I invite the European Commission, and I invite all of you, FESE, and all of you to work on this, because if we are not able to make investors to trust in the markets again, I don't know, maybe we can meet here again in a couple of years, and probably the situation would have changed a lot, okay? But it's important. Companies, they want to go public, but when they ask me, okay, can you guarantee that we are going to be able to raise, I don't know, 10 million, 50 million? I'm not speaking about big money, okay, 10, 15, 20 million, in a primary offering. I'm going to get it. I don't have the answer. I cannot say yes, 100% sure we will raise that money without any problem. If I tell that company, okay, let's go a private funding, let's go to meet some private equity funds. Today, I feel more, let's say, I feel more confident that I will be able to succeed. Okay, this is my feeling. I don't know if there is a solution for this. I really trust on the capital markets because my experience is great on that. And as I said before, I think there is a big gap because Europe and America, but 2, 3, 4 years ago, I felt more optimistic than I'm today. Okay.
Thank you. Thank you so much, Jose Antonio. In fact, you really touch on many areas, and there will be a dedicated panel on retail precisely on the points you were saying. And you said something I very much believe in, which is the societal component that capital markets have. So by bringing more companies into the public markets, you also bring the investors in a transparent, common marketplace. And I think this is definitely a very clear kind of component to identify, develop, and very kind of robust economies. So it's very important to take that into consideration. And you also mentioned the fact and the reality that private equity seems to be really the area, right? I mean, where, you know, it's growing, there are no problems there. But precisely of this societal component, we really need to see how we can revert this trend that you were describing, and also colleagues earlier were saying. So I would like to then to close briefly this round with you, Francisco, to give you the floor, to then go a bit more into zooming on the things that already Jose Antonio kind of introduced. But in your view, you are working for CEPIME, Francisco. CEPIME, for those not familiar with them, is the Spanish voice for SMEs. So you are faced with all sorts of companies that look financing in many different places, not only on the public markets, but also on the private ones. So what is the situation that you think your members are facing, and how do you think this could link a little bit with the listing package? If you can please be brief on that, Francisco, because I would like then to spend time on the second round. Thank you.
Okay. The situation is the following. You say before, we're speaking a lot about how to make more attractive the markets for the small and medium enterprises. This is key, but also it's more important that the companies that we have were attractive to the investors. Jose Antonio said before, also say before the head of BME wrote, also we need investors. This is the key. And what's the problem? What offer the small and medium enterprises in Spain to the investors? Some of them offer growth, offer value, but the majority are so small. In my opinion, and for me, it's so disappointing to say that. I have a bitter vision of the situation. Are not interesting companies with 20 employees and sales of 2 million. Or in our case, that we made a project that in collaboration with BNE Markets, that is to find and to identify the most growing companies in Spain. And in this exercise, we find a lot of good companies, but the conclusion is the majority are, in my opinion, small. Why? We're speaking that on average, they have sales of close to 20-70 million. It's not bad quantity for Spain, but in the global world, it's small. But what's happened that when you take into account the EBITDA, we are speaking an average EBITDA of 2.7 million of euro. When you try to give a value of that enterprise, and you say, I use the multiplier of 6 or 7 times EBITDA. It's true that you can use a standard number, but if you say, I take the standard 6, 7, you are speaking that the market value of the company is between 15 and 20 million. 15 and 20 million, in my opinion, is low. It's low for the things that are demanding the international investors. My experience that before working in CEPIME, I worked during 70 years in a big Spanish broker, is that a lot of our clients, when you say, no, this company is below that value, this investment fund is less than 100 million, say, no, my investment universe is impossible because it's from 100 million to 100 million, and this is the problem. The problem is the size. We have to offer companies with an interesting size to the investor because the investors are demanding that. We have to try to make grow the companies, and we are trying to do that with BME Growth with this project. Identify these companies and give tools to be bigger and to be more attractive. But this is the problem today. We don't have companies as the size as the investors demand. It's true that during the last 10 years, we have a successful experience with BME growth. We passed from 20 to 100 companies. But we have in Spain 27,000 companies that are medium-sized, that are interesting, that have to grow, that continue, that we have to try to go to the markets, to be listed, and to permit that this desired really success have to be no company of 26 million. We have to permit that will be companies of 50 million. For that reason, when you take into account this reality is, yes, we speak a lot about, is it the market interesting for the companies? And we have to improve the situation. Yes, we speak a lot about that, but we have to offer to investors the things that demands. And for this reason, improve the regulation is important, but it's not sufficient. It's totally necessary, but not sufficient. And this is the main challenger. The main challenger is to have the companies that the investors want, and the main challenger, as you say before, as the head of BME Growth is to find these investors. And when we are speaking about and say before, Jose Antonio, the investors need to trust another time in the markets. I think that they trust, but exists one problem. Today, to be small is a problem because the people don't want small things. The people want global things. And when you go to investment committee, if a manager decided to invest in a small company and have a problem, the problem in the committee is so important because the bosses, the system assess better that you fail with a big blue company, a blue chip, than with a small company. And this is the problem. It's not the trust. The problem is that when I invest on that and I report to my boss and say, no, with this small Spanish company that is a long-term project that I think that in 5 years the price will be 3 or 4 times more, but today lose 10%, I say, oh, no, this price affect a lot to the price of our fund. But if you buy blue chips and fall 20%, no problem. It's the market, it's a trend, and it's not the problem. Yeah. And this is the situation today. We speak a lot about if it's interesting in the markets for the small companies, but also we have to think that the small companies and medium companies have to be interesting for the investors.
Absolutely. Thank you. Thank you very much for these reflections, Francisco, because indeed we really need, I mean, we do have the number of SMEs, but we need to make them indeed grow so that they are really in a size to be able to go into the market. But also, very importantly, and you also alluded to that, is about the valuation of the company, right? So that the investor is interested in putting the money into this company. So it's really like kind of a very kind of one-to-one situation. Now moving into the second round, I would like precisely to discuss a little bit more in detail the issue we have with the valuation of companies in the European Union. I mean, it has been identified as one of the main problems. And if we compare to the US, looking at turnover velocity figures, we see that the US is about now 230% compared to only 35% in the European Union. So we really lag behind. But if you ask me, in my opinion, we are facing a vicious cycle here. And one thing fits from the other, in the sense that there are 3 main components that have a lot to do with the market structure that we also have in the European markets, if we compare to the US. First, we have fragmentation of issuers. Here in the Union, we have 27 jurisdictions, we said it earlier, with several 27 national laws that still issuers need to adapt to. Peter was mentioning that. And this, of course, puts things very difficult when compared to the US, which is one single jurisdiction. The second one, you said it, Francisco, earlier, and all, in fact, investors. Again, with this fragmentation that we have of issuers, we also have fragmentation of investors. We still have many, I will say, solid investor base at local level in the European Union that also needs to adhere to the different national laws. So still, even though single market, this fragmentation, I think, is a heavy weight that is stopping some of the dynamics compared to the one very big and depth investor base that you have in the US, and by the way, all located around New Jersey. So I think these two factors are very critical when it comes to where do I go for a company. And the third one is the fragmentation of liquidity. In the US, you have all the liquidity concentrated in two main exchanges, NYSE and NASDAQ, but also they are all placed in the same region around New Jersey. 200 venues, so liquidity is very much fragmented. We not only have, and by the way, they are quite concentrated, regulated markets, but we have a big number of systematic internalizers, still OTC players, and MTFs. And all that kind of makes that the situation is not at all a rosy picture. So, I mean, I don't want again to sound very negative, but now looking at this comparative landscape, Florence, I will turn to you. From the issuer's perspective, you are advocating for the European issuers and the ones that are in big size. So what do you hear from them? What's your view with regards to this competition that we're facing from the US?
Thank you, Rosa. A lot of comments have been already expressed, and it's interesting to look at the angle, and I'm very interested by the points mentioned on the size of companies, but it's not the topic of discussion now. I think overall, I mean, our goal is to, I mean, before you go to investors, before you move to liquidity, I mean, you need to have companies indeed on the market. So the question is the depth of the CMU agenda to be attractive, to be liquid, efficient. A lot of points have been mentioned, and I don't want to repeat them, but the way they have been tackled maybe is not, I would say, it's not ambitious, should be, you know, move forward. I mean, when we look at all the actions and the proposals that were on the table, not everything has yet been tackled. So, and we are not talking about what has not been tackled. We had two different angles also that have not been, you know, taken into consideration. Was in the transition. I mean, always continuing to mention, how do we ensure transition for companies that are here on the left of my side to the big ones and the ones that are, you know, continuing with you don't really, I mean, we cannot really sometimes tell this transition story and this adaptability to the new regulation. I mean, we always need to explain why companies need to adapt, and now it's adapting to the sustainability agenda. And I'm glad to hear that actually, you know, corporate reporting was not among the critical issues, because it's good, because it might be also good sign that companies are already, you know, providing enough, you know, information for the investors on that front. Now, is it because only of the U.S. regulatory framework? Because this is, you know, what we are focusing on. It's probably not the only thing, and from that front, the actions that will be taken by the Commission in terms of the single market report on the competitiveness check will be probably opportunities to look at the entire framework. You know, why companies are not necessarily listing in the EU? Is it only, you know, because of the listing environment? But maybe this is not only the reason. Looking at, you know, market developments. The consideration of the 25% reduction of reporting requirement is also, you know, an important step in order to make this, and we really applaud that. Sometimes one of the aspects that is maybe not taken into consideration, and we hope that in the future will be, you know, probably better streamlined with the ambition is contradicting political agendas. What do I mean? Sometimes you have the intentions, you know, that are developed within the capital market, and I was still discussing this even yesterday with some representatives, and try to see, you know, why on one hand you are trying to improve, you know, the system for corporates through better regulatory frameworks, and on the other hand, you see further compliance develop in other legislation that are being discussed at the moment, and it goes, you know, even attention to the due diligence aspect, but also sometimes even to the sustainability agenda. Is it really realistic, pragmatic enough to ensure economic viability? I mean, sometimes it's forgotten that actually, companies, okay, to invest, they need to showcase themselves, to have the equity story, and all of those aspects eventually have to be taken into consideration, when drafting future legislation and making the environment where companies want to stay in Europe and be Europeans.
Thank you, Florence. And indeed, this is something also I am on the sides, on the margins of the events yesterday. I discussed with some people, the kind of the political agreement and willingness to really try to move these things forward, so not to have these contradictory objectives, because otherwise we can end up in a situation that is not desirable. Jose Antonio, back to you. So what do you advise to your clients when they come to you and you see that the situation is ready to go public for the company? How do you see this competitiveness that we face vis-a-vis EU-US?
Yeah, okay. There are some companies that they want to go public. Some companies, they are a little bit lost. And they ask for advice and they tell you, okay, I want to raise funds, so I've heard something about public markets, so I don't know if this is for me or not. I also have heard something about private equity, family offices, private investors, so, and you try to explain everything, to explain the pros and cons of every kind of investors, which are totally different, believe me. It has nothing to do to go public than to, I don't know, to incorporate a new partner in your equity with a 20% stake. If it's a private equity fund, where you have to negotiate not only the valuation of the company, but also the exit clauses in 5 years' time or whatever. Okay, so this is totally different. There are some companies that they want to go public because they want to sell only a minority stake percentage. They want to remain independent. They want to, maybe it's a family-owned business, and this is the dream of the family, to go public and so on. This is beautiful. This is great. But as Francisco was saying, and that's a very good comment, in general, here in Spain, the small caps, there are small companies. But there are also, let's say, what we try to find, and this is a commitment we as Norgestion and some other advisors we have with the market. This is something I've discussed with Jesus González Nieto several times. Altogether, we need to improve the market. Altogether, we need to bring to the market, let's say, bigger companies, stronger companies. And this is like a virtuous circle, okay? The bigger the company is, the more interesting the market becomes. Okay, remember, probably you don't know this company, Jesus and Manu, they know it very well. We work for a Basque company called Arteche. Arteche is a public company right now. Arteche is a 20-something, 30 million euro EBITDA company, 300 million euro sales, industrial company with facilities all around the world. This is the typical company we should work for. I don't know if the company, the evolution of the company is going to multiply by 3 in 3 years' time. I don't know. Nobody knows, okay? But I know this is a very sound company, a very strong company, and that is a very trustable company for investors. If we are able to convince to attract those kind of companies to the market, I'm sure we will be able also to attract investors to the market, okay? But believe me, when you explain, a normal standard process of what to do to go public, everything is positive. Everything is positive because, and this is something I learned. I learned from my first experience to the second, to the third, to the fourth. And now we are believers. I mean, not just some other advisors, we are believers of the market. But it's true that today we cannot guarantee, we cannot secure money for the client. And the client, at the end of the day, what he's looking is for prestige, blah, blah, everything, but money as well, okay? So, and again, on my hand is to try to, we have said no. I mean, our clients, they said no to Norgestion many times, this is true, but also we are able to say no to some companies that don't want to go public because we see them very weak. I mean, they're small. I'm sure they're going to be attractive at the age of investors. So what we have to do, our commitment with the market is try to bring to the market stronger Spanish companies, and this is the way we work. Okay, if we are able to succeed in our, let's say, mission, I'm sure that some other companies they will be keen on going public as well.
Thank you. No, and indeed, it's obviously very crucial that you advise rightly. I mean, this is not for everyone, right?
No, absolutely.
Because a failure that you can see coming, better not to have it.
This is an important point from a private company, as we are. If tomorrow we advise a Spanish company, in a private equity transaction, and it doesn't work, nothing happens. I mean, this is below radar, okay? If we advise a public company, Jesus mentioned before, a scandal in the. No, just had nothing to do with that, okay? That's important to point out. Now, if there is a problem with a public company and you are advising that company, I mean, your reputation is in danger.
Exactly.
And that's very important for us as well.
Exactly. Absolutely. Reputation is key also. And by the way, you mentioned Arteche, which was one of the nominees companies last night for the awards. So,
okay. Yeah, you're right.
We were very pleased to have them with us. So, indeed, so they made it into the short list. Now I would like to turn to Aurélien, precisely on this topic about the US, because I think, according to some data that Euronext has been collecting in-house, the American dream of kind of going listing in the US and having a fantastic base of investors next to you and so on, doesn't seem to be, according to your numbers, the reality once the company has gone public. So in the post-IPO process, which is probably the one that goes a little bit more kind of discreet, Euronext apparently has some news there. So I will be very interested, and probably the audience as well, to listen to you on what is your latest research on that.
Thank you very much, Rosa. So as you pointed, and as was pointed at several occasions in the panel, we always look at the US market as a green field, a place where things go well, where retail investors invest into equities, where the markets are deep and very liquid and very attractive. And in isolation, that's true. The US market is much deeper than the European markets. And so this easy conception trickles down into clients and some advisors, etc., thinking that, okay, maybe if I have a beautiful technology company that I built in Europe, the future for me is to list in the United States. And this is a very true competition that we see on the most interesting assets that the European economy can produce as future IPO candidates. So we looked at the prospects of a listing in the US for European companies, and we try to see if the outcome that people hope for is true. And as Rosa mentioned, my take is that it's not, and I'll explain why. So we looked not at only US companies IPOing in the US and the outcome of that IPO, or European companies IPOing in Europe and the outcome of that IPO, which leads to a different outcome. But we looked at what interests us is European companies choosing to go to the US for their listing. So we had a third group for comparing that analysis in our stats. And we look at the key metrics that are generally accepted, and I'm happy to onboard any others if you have better ideas of what the success of an IPO looks like. So that's liquidity, after-market performance, the valuation of the company, the level of research coverage they get, the fees they pay for the IPO, the investor base they secure in the IPO, and the index inclusion they secure, which are kind of the seven, I think, key decision factors in an IPO. So looking at them one by one, liquidity is comparable for European firms, whether they IPO in the US or in Europe. Average daily traded volumes are around 0.5% of the float. In the US, they are 1.8, but as a European company in the US, you don't get that 1.8 because you lack the visibility. The aftermarket is significantly worse. And I'll put a small caveat on that study, because obviously the sample size of European companies going into the US is small, fortunately. So we looked at companies that raised over 250 million euros since 2018. Those are 12 companies. So there is some statistical significance to this, but it's not totally robust. So average one-year performance of European firms IPOing in the US is minus 39%, versus European firms IPOing in Europe around minus 5%. Valuations, if you look at the usual metrics, enterprise value over revenue, enterprise value over EBITDA, price earnings ratio, they are comparable, in fact. And specifically, we try to explain to prospective clients that the value of their company will be driven by their business and not by their listing location. If you look at ASML, it trades 46 times PE, KLA 23 times, L'Oreal 37 times, and the competitor in the US, Procter & Gamble's 26 times. So it's really dependent on the company. Research coverage, the number of analysts covering a stock in Europe on the sample we looked at, sizable IPOs, European companies IPOing in Europe, 7.4 research analysts covering a stock, European IPOs in the US, 7.2, so pretty much the same. US IPOs in the US, 11.5. You could be fooled, but you're not going to achieve that outcome by being a European company in the US. Fees, IPO fees are about 2.3% of gross proceeds in Europe. They are 5.86% on average in the US. They could be higher for smaller objects. So this is a significant component. Mm-hmm. The investor base people secure in IPOs tends to be heavily skewed towards US investors in the US. Is that by itself bad? I don't know. We usually say to management teams, think carefully about it, because will your investor base understand your own operating constraints? If you're a European company, I don't know. We have different labor laws. We have different regulations. Maybe it's better to have a more balanced investor base with more European investors in the shareholder base. And then index inclusion. It's often highly unlikely to achieve index inclusion in the top US indices for European companies for various reasons, one of them being valuation. The threshold to achieve a flagship index inclusion in Europe is much lower. And so this is a significant driver of liquidity and of positive outcome to the IPO. So we usually tend to show this to clients.
Thank you, Aurelian. And indeed, if your sample then gets even a bit more statistically robust, I think these are figures that are worth to show not only to policymakers, but also to make a bit more public, because I think maybe companies do not know exactly about all these findings, and it's interesting, to keep that into account. I'm mindful of time, so we only have 5 minutes left, and as being one of the organizers, I should be very diligent with that. I know, Francisco, I didn't give you the floor yet. I would like to do a very quick last round. Please, maybe we give 2 minutes to Francisco, 1 minute for the rest, to please condensate your message there, because I would like to look at the future. Political mandate. This is something that in Brussels is very much discussed now, what the new Commission President and by de facto Commissioner taking place, by the way, in a year's time, which will be 1st of November next year, what that person will have to do. I think we have really described very well that the situation has many challenges. We also saw as well some of the good practices. So I will start with you, Francisco. Please, 2 minutes. What do you think the future should look like with regards to improving the situation?
Okay, the first one thing is to take into account all the framework, because in this occasion we are speaking a lot about the regulation in the capital markets, but it's more important to take into account that we have to permit that the company is growing, and that and avoid that the 55% of the companies, when you ask what is the main concern for the companies, the answer is the administrative burden. This is a big problem. We're creating a region where to growth is so complicated to the companies. For example, in the case of Spain, we have more than 100 regulations that activate when the company have 50 or 100 employees, that when you achieve that number, sometimes the businessman thinks, it's good for me to have 51 employees, 102, and say sometimes no, because I pay more taxes, because I have more burden, administrative burden. We have to transform all these things. We have to create a smart regulation, a smart environment, because when the Business Act, a Small Business Act, 15 years ago, say, think small first, the real situation, the current situation today is that nobody in the European Commission thinks small. They say that think small, but it's not true. Only some points. If you really think small, the majority of the companies in Europe, independently from Spain, Austria, Poland, Czech Republic, if you really think that, the majority don't answer that, have a problem with the regulation. We have to create a regulation that permit to grow the companies to be attractive to the investors, also in the point of view of the taxes. And what's referred to that not is only to pay a lower corporate tax, that is important but not the main. It's to create a tax system that permit, that made easier to make a merger and acquisition of small companies. Today in Spain it's so complicated. You go to the tax agency and say, no, I want to merger, and when you are there, 5 minutes later say, no, it's better to be alone.
Yeah.
But to merge the companies, to make easier that, and to create bigger companies, it's so important that when the company, as Jose Antonio said before, arrives to the BMI growth, it's not a company of enterprise value 20. It has to be a type of architecture company. 200, 300 million, something like that. Okay. And this is the future. I'm sorry that is more than 2 minutes.
You made it very clear, Francisco. So incentives, simplification, and harmonization.
Yes.
Florence, your take, please, very brief.
Yes, thank you, Rosa. I think it depends a little bit, but we are preparing for it for the moment. But what we hear most, I would say, easy in a word, is pause. Let me explain what pause means. It's a proper fitness check of every piece of legislation, taking into consideration proportionality, it was mentioned, report it once, principle, probably incorporated, and have better regulation. And I mentioned, the political decision versus the technicalities, reduce hurdles, continue to this hand, and then practicalities in the implementation. I understand that companies need efficient implementation, practical solution when it comes to implementation also on the sustainability agenda. And we want to make sure also there are no further requirements when it comes to the relation, because I think relation between listed companies and owners are already very well balanced in the sustainable corporate governance frameworks, and we don't want additional stakeholders engagement with further compliance disclosure for companies. And this is, so
okay, no, I think that's very clear. Florence complements very well with what has been said. So better regulation, being very practical, because, for instance, yesterday we had a very nice discussion with some of your companies that they were in their words, and they were saying the complexity that they are lost in translation, so to say. Jose Antonio, from what has been said, what else will you add? Because I'm sure you agree with everything.
No, very positive about this Listing Act initiative. I think it's going to be positive for the market, to improve the capital market. And from my point of view, we have to work on two sides. Okay, just trying to bring bigger companies to the market, and trying to bring back investors to the market. This is like a virtuous circle. Okay. The bigger the company is, so we have to work on that. And I don't know, trying to motivate pension funds, trying to motivate insurance companies to start investing again.
Absolutely, very good kind of conclusion on the virtuous cycle. Last word for you, Aurélien.
Very short. I think we need to focus on mobilizing investors to invest in public equity. That goes for pensions, retail, and also public investment. So maybe an initiative like InvestEU could be extended to the public markets. We need regulatory simplification is the second thing. We believe we need more supervisory convergence. This probably goes through an empowered ESMA and moving towards single supervision in the European Union being one of the main future goals.
Thank you so much. I think it was a very interesting panel. So I thank my panelists. So please help me to applaud them. We got I think we got a very good list, a wish list on things to do. So I took note, and I, in my capacity, tried to convey these things to the Commission. Thank you so much. Thank you.
No, thank you very much. I think outstanding panel to really bring across harmonization, simplification, smarter regulation, less burden, think small, and I also learned that the US is not always the Holy Land. Let's come to our last panel, unlocking the potential of European investment for the real economy, and we heard a lot about the need to empower investment. So I would call our moderator, Adam Costal, Senior Vice President and Head of Listing EMEA from Nasdaq, on the stage, and also would ask the panelists, Unai Ancejo, CEO of Indexa Capital, Alexandra Machinska, Executive Director of Better Finance, Jesus Sanchez-Guiones, Managing Director and member of the board of Renta 4, and Marek Dietl, the CEO of Warsaw Stock Exchange. So, Adam, the floor is yours.
Just keeping track of time as well. So good afternoon. Great to be here. And maybe I thought we'd take one quick round to just introduce ourselves in the capacity. I know titles sometimes are very broad, but it would be great in the context of the discussion that we're about to have. Picking up on the previous panel, very timely and very relevant. It would be interesting to maybe have a first round of introduction. Maybe we start on the far end and just a quick introduction. Thank you.
Okay, thank you. Thank you very much for the invitation. My name is Unai Ancejo. I am the CEO of Indexa Capital Group. I am no expert in regulation, but I think that I have a vision about the topic of today, because Indexa Capital Group is an asset manager. It is a retail asset manager. We handle the money of 70,000 people in Spain. And also Indexa Capital Group has been listed in the BM Growth before summer. So I'll try to be useful with my insights.
Thank you. That's very relevant that you act on both sides of the market. So great to hear. If we continue with you, Alexandra.
Hello, Alexandra Mączyńska. I'm acting managing director of Better Finance, and Better Finance is a federation of national individual investor association across the EU. So we have member associations in most member countries, and we really base our opinions, advice for the European policymakers on the input from the member states and from retail investors. And I wanted to thank you for inviting a representative of retail investors to this panel, because we are supposed to talk about unlocking the potential. And the potential is there. We have a very high savings rate in the EU. It's over 12% compared to the 7% in the US. So definitely the potential is there, and I'm happy to discuss today about what we think could help to unlock this potential.
Excellent, thank you. And Jesus?
Hi, good morning. I'm Jesus Sanchez-Quiñones. I'm General Manager of Renta 4 Banco. I've been working for this bank for the last 34 years. This is an entity that's very focused in financial markets and giving access to retail investors and not so retail families to markets. So I think that it is the experience that we have had in the last 3 decades. We see that right now there are less retail investors investing in the market directly than 10 or 15 years ago.
Marek Dietl, Warsaw Stock Exchange. I've been running the exchange for over 6 years now, but my background is not that orthodox for the exchange world. Before joining the exchange, I spent 6 years in venture capital industry, and before venture capital, I spent 10 years in a global consulting company.
Excellent. And a quick introduction to myself. I run and operate the listing business for Nasdaq here in Europe, which covers our Nordic, Baltic, and Icelandic platform in terms of the listing offering we have, both in attracting companies and also managing the companies that are listed with us, but then also focusing on the US offering for European companies, making sure that those companies that decide to go to the US choose Nasdaq as a listing partner. So we've heard previously a bit about the differences between the US and Europe trying to emulate the success of the US markets. I have a personal experience with the Nordic markets, which I find very relevant in the context of engaging the retail market. So I'll touch upon that throughout the discussions. But Alexandra, you mentioned the untapped potential. There certainly is a lot of untapped potential. There's roughly 10 trillion euros locked into investments. We as Europeans are better at saving than investing. And I think if you look at the historical outcome over the last 10 years, or rather the previous 10 years, I think investing has certainly been in the favor rather than saving. Currently, the market is in favor of savings because finally we have interest rates on saving accounts back again, which we haven't had for a very long time. I think there's a lot of focus now across Europe to make it safer, but I think the focus should also make it easier for retail to access in a predictable and manageable way. So from that perspective, the retail investment strategy that is being launched by the Commission and was launched as proposed in May, it tries to address a lot of these different topics. And from our perspective, we really do see, as an exchange, the need to really engage retail. I think from our perspective, it's making sure that companies have access to investment opportunities in an easier and transparent way, but also from that perspective, I think there's a lot of focus on the day of the IPO and the access for retail to access the day of the IPO. But for our perspective, if we look at the Nordic markets, it's equally important to look at the secondary market. And it's a combination of making sure that investors are educated and understand in what they are investing in. But then once they are investing, that this is a manageable asset class. And by that I mean it's important that taxation and the structure around the investment is also very predictable and easily managed by retail. Otherwise it becomes too complex and too difficult for them to engage around. We are very positive to the engagement from the CMU in terms of making the markets more accessible for retail. But from our perspective, I think there are a lot of different aspects which are trying to address things or solve things from a regulatory perspective. But I think we should really try to focus this panel more on day-to-day, on where is it that we're seeing issues and where are we seeing opportunities that we could tap into. So let's start maybe from the end. Unai, you are both a broker, but you're also a listed company. What is it from your perspective that you think could be done to really increase the engagement from a retail perspective?
Yeah, thank you. Well, from the point of view of an asset manager, what I would say is that retail investors, they look primarily for two things. First is liquidity. If they want their money back, they have to get it as soon as possible. I haven't known many retail investors that that want to lock their money for many years. So that's the first thing that I would say. That demands liquidity in the instruments, in equity. So that goes again for the last questions that we had, how to improve liquidity in European markets. Also, the second thing that retail investors want is return, right? But they also want security. They don't want to get too much risk. They don't want to see losses. And from that point of view, one thing that we need, we are going to get that deeper next, but we need more education. And that goes with teaching our kids how investments go. That's my personal view. We as fathers, we are in the position of, investing for our kids' money, and the best way of knowing something or learning something is by practice. So that's the first. And as a company that has gone public, my experience is that all the liquidity that we have had is from retail investors. We are listed in the BME Growth, and we haven't seen too much institutional money there yet. So what I would say is that at least in our experience, retail money is there, but in our case, I think it is related to the situation that we have already as clients many retail investors. So they like the company, they wanted to invest money in the IPO and in the next days. So engaging retail clients, making them to invest more if they are savers, it is very difficult. You cannot push them to take more risk than they want, because that is going to be short term. When the markets go down, they will go back to where they previously were. We have seen this in the last years, where interest rates were close to zero. Many savers were pushed to assume risks, and many of them they are going back again to be savers, because in reality they were not investors, they were savers. So my advice would be to try to give as much information as possible. From the regulatory point of view, what I would say is, what I'm seeing is that it is more and more difficult for asset managers to communicate clearly with clients because of regulation. I have seen that myself. For example, I have seen this in a brief in a resume that I have given about the regulation of the retail investment strategy. And I see, for example, a specific point about marketing, communication, and practices. And for example, they want to reduce marketing practices through finfluencers. I know that finfluencers can be bad, but they can be good as well. I mean, many people listen to finfluencers right now. Many influencers say very, very sound things, like you should invest, not only save. So from a regulatory point of view, I would say to try to not too difficult the message that people should invest or not save.
Thank you very much. I think it's the balancing of educating and then marketing and the complexity of managing the regulatory environment around that. But we'll come back to the points that you raised, but let's continue around the table here. Alexandra, what would you like to add in terms of your reflections and what your focus areas are from Better Finance perspective?
Yes, thank you. I would agree with many points made just right now, but I think we need also to remember from what starting point we are right now discussing retail investment strategy and many other things. The fact is that the financial education of the EU investors and citizens is quite low, and the financial literacy is quite low. Being an investor is, of course, not a full-time job for most of the people. So therefore, with the retail investment strategy for Better Finance, really one crucial point was what we were really counting on with this proposal from the Commission was to really ensure access to unbiased advice for investors. So really an advice that is given to investors in their best interest, and we think that the system that we had so far in place, and it's not only what we think, it's the studies done by the Commission, it's the impact assessment of the Commission and many additional studies, it's also the annual research from Better Finance on the real net returns from long-term and pension products, that is really pointing to the fact that the current system did not serve retail investors well. So one of the things that you also mentioned that is important for retail investors is decent returns. And for us, decent returns would be the returns that at least are able to cover, for inflation. And in many cases, this is still not the case. Moreover, even when we look at the financial education, and I very much agree, I mean, we should start very early, and this is definitely something that Better Finance very much supports. So financial mathematics, information about capital markets at a very young age, but this is going to bring results in decades, not right now. And for adults, the best education that they can get is actually at the point of sale. But right now, they are not really getting a proper education because, as we have seen also from the impact assessment, additional studies, many times if you have a system with incentives that are rather placed so that the most expensive products are being sold and not the ones that are really providing the best value for money for the investors, then you have problems also with the trust. And in fact, I think it's around 40% of the retail investors right now in the EU, less than 40%, that are convinced that the advice they're being given is really delivered in their best interest. So we have trust problems with retail investors. The rate of investing is still quite low. And we really think that if you manage to really ensure independent advice, really good advice for investors, would be a very important first step forward. And therefore, for example, one element in the retail investment strategy, so the ban on non-advised sell, of inducements on non-advised sell, is a very important element that we think is going to help, even though it's of course going to be limited in scope, because as you probably know, even though the Commission is striving for a level playing field between the funds and the insurance-based products, the Commission is also allowing for an opt-out. So member states are allowed to ban non-advised sales for insurance-based investment products, and investment funds, it's only a part of the whole portfolio then in which right now retail investors are investing. So maybe as a first comment, this would be that.
Thank you, Alexandra. So, Jesus?
From my point of view, this new regulation is very focused on reducing costs for retail investors. And in 34 years, I've never seen commissions going up. They have gone down and down, while costs have been going up and up, mainly regulatory cost. And really, right now, for example, commission for a retail investor, at least in Spain, it's nearly 30% what it was 30 years ago. And it is the same even with funds. So the market itself helps with competitions. Trying to say what is the maximum level of commission for retails, or saying the profitability should be compared with this benchmark, let the market works itself, because if a provider gives a bad advice, or their mutual funds, or even a stock that is in the stock market doesn't perform well, and the forecasts are not fulfilled in the future, it will be out of the market very soon. So trying to regulate too much and try to put a limit in commissions, it is not in help of retail investors. In my company, in Renta4, we started offering international funds in 1992, when we made a lot of agreement with entities, a lot of investment in IT, a lot of investment in education and training of the personnel. Well, if you got the commission that you are going to receive very cap, probably nowadays it would be nearly impossible to make this offer to retail clients from scratch. So we must be very careful with this idea that the lower the commission, the better for the retail investor, because it leads to index funds. And if we are all investing in index funds, Indexa Capital, for example, would have been very difficult to go to the market or to grow, because it would be very difficult to find new investors.
Thank you. I think this is a very interesting topic. I think there's a lot of focus, even in the IPO discussion on the listing side, there's a continuous discussion about the cost of listing. But at the end of the day, if there's no cost, there's no return of investment for advisors and investors to engage. So from that perspective, I think it's a balancing act in terms of reducing costs, but also making more accessibility and broadening the range of investment opportunities. But Marek.
So I fully subscribe with what was just said. Maybe I will chip in with another angle. It's about products for retailers. Just for those who don't know the Warsaw Stock Exchange that well, actually the recreation of Polish capital market was in 1991, and it was primarily driven by the interest of retail investors. So retail investors really built up this exchange. Despite the ups and downs in the regulatory environment, we still maintain a very healthy retail base. And I will give you a split between our products. So on our equity side, we have currently 17%, and in the last few years when I was running the exchange, it was in the range between 11-12% to, in the peak of COVID, 27%. In our derivative sides, we have between 30 and 40%. Currently is 34, I think. And also there's a vast interest in our structured product where the retailers play a major role. It's a relatively new market for us. And in our new Connect, what's equivalent to BME growth market, where we have close to 400 companies, 82 to 90% of the trading volumes are done by the retailers. And this leads me to the finding that, first of all, you need a full-fledged product portfolio for the retail investors to make them invest. Of course, you need a retail investment culture, and you also need to aid those investors in their journey through the capital market. What we witnessed at our venue, at least, was that when there was from 1999 to 2014 compulsory pension funds, which were strongly home biased due to regulation and other reasons, there was, of course, the share of retailers was also growing because they knew that there is a increasing demand for stocks, so they can always offload their stake to the pension funds, which get 1 billion euro per quarter, and they are long only, so they will be buying. Then there was a disruption in 2014 when the pension funds were dissolved and half nationalized, and they were not made compulsory anymore. And then there was a huge drop in the share of the retailers. And slowly by steadily from 2017, when I took over my current duty, we are building up this retailer share. So one is product, another is that demand-supply relation. And what was helpful in building up or rebuilding the interest of the retailers from this, whatever, 11% to 17 now, and in the peak 27%, was one thing was the outgoing government introduced another pension scheme, what was a hope for the investor that there are another institutional investors in the marketplace. But we also helped retail investors. I will make a deep dive in the future intervention, hopefully, if the moderator allows me to do this. But one thing what played very well with the retail investors was our program for sponsoring the research, equity research, and it was very helpful for the retailers. And this helped a lot for them to somehow compete with the professional investors, so they can go directly to the market with the same set of information. And I mentioned that because today we announced the 4th edition of this program with another 60 companies, so we are very proud of that. And that was, at least according to the study we did on the retail investors every year, was a very helpful thing, and other measures gonna follow. Thank you.
Thank you. And in terms of the research coverage, because I guess that also goes into the literacy and the access to information, how do you qualify the companies that get to participate in the sponsored research program?
First of all, we do not qualify.
Okay.
So we let the brokers to propose. The only condition is that it should be less than 2 analysts covering this stock, 2 or less, so okay. 1 or 0. So the brokers propose where they think there can be a, added value, and usually we tend to agree. And there is a kind of auction, so the lower the fee by the researcher, the more companies they can cover. So it's called Dutch auction, so the price decreases in the auction.
Interesting. So maybe a reflection on the Nordic markets from our perspective, and also maybe a comment on the US markets and what we're seeing. I think one topic that keeps on coming up is the return of investments. And we tend to forget that Intel was an $8 million IPO. And that Apple was I believe $50 million IPO at the time. And so I think if you look at the return of investment, of course, it's unfortunate because we look at historically now the last 5 to 6 years where we have had, and particularly in 2021, I think we, on a global basis, saw something in the financial markets which we have never seen before in terms of the listing activity. Only in the Stockholm market we had close to 200 listings. In the US, only on NASDAQ, we had 700 listings, 400 operating companies and 300 SPACs. And of course, the return of investments, if you look back from 2021, has not been significant for those investors that participated in many of those IPOs. The return has not been particularly well performing. So I think we have to educate there has to be a level of education on the long-term investment return for the retail community. And I think from that perspective, the patience amongst retail investors tends to be to look for products that are more leveraged and potentially also products that potentially can give a quicker return, which is a bit concerning. And I think we have to educate on the cost of those products in many cases. From a retail perspective, we see a continuous frustration in our Nordic markets that the retail does not get allowed to participate in the IPO as much as they would like to. The problem with the IPO participation of retail is that investors or advisors see this as a very volatile exercise. They can't allocate as much to retail, and therefore we see that they try to minimize the amount that is given to retail to minimize also volatility. And typically that volatility comes with the fact that retail is allocated a relatively small amount, and that small amount induces them maybe to sell in case they actually just get a 10% increase, or this increase was, big enough for them, but it's the post itself, the investment opportunity does not entice them to be a long-term equity owner in that company because it's a relatively small portion. So that's a continuous dialogue that we have in the market, that is it a democratic right that retail should be given access to an IPO or not? But equally it's important that I think the companies need to be educated on the importance of having retail involved in the IPO, because I think that's something that many advisors discourage them from and take control of, because they are paid on the execution of the IPO. However, having said that, 40% of our trading in the Nordic markets is driven by retail. So equally important to educate that the beginning of the journey is not, if you're not part of the first day, doesn't mean you're not part of the continued journey. So I think there, from that perspective, the secondary market is very important. And what we have seen throughout the last few years here is that it's not only on the day of the IPO that is important. It's the secondary market, the ability to participate in the additional capital raises. I think one thing that is very complex across Europe is the legal structure and the regulatory structure to participate in secondary transactions. I think in the Nordics, what we've been able to do is to make that very transparent and easy from an investor point of view and from a company point of view to issue new shares. So from that perspective, I think that's equally important to make sure that retail are educated that how to participate in these secondary transactions, how to make sure they understand the longevity on the long-term investment cycle. If we look at the US, we are in a position now where we had a boom in 2021. Of course, that has corrected quite significantly. I think overall on a global basis, we're seeing now that we're seeing a lack of inertia in terms of investors. A lot of investors are waiting for momentum to take place, and therefore we're seeing investors not making decisions, whether it's pension funds or whether it's private funds or whether it's retail. So from that perspective, we just recently had an IPO in Sweden, one of the most familiar brands in the Swedish market. A lot of the smaller funds were not able to participate because they were downsizing their funds and trying to correct the outcome of their existing funds rather than to take on a new opportunity. I think from that perspective, we are in a very, very difficult time right now, but it's important that we see the longevity and the commitment to make sure that our markets are accessible. To your comment previously about the cost of access, I tend to agree with you. I think it's never been cheaper to access the public markets from a retail perspective. So I'm not sure it's an incentive to drive that cost further down. From a trading perspective, I'm sure there's things that we can do from a clearing and settlement perspective. But from a trading perspective, it's never been easier, it's never been cheaper. So it's important that we continue to see that retail brokers are incentivized to participate in the market and are incentivized to engage in the market from a long-term perspective. From a liquidity point of view, we are seeing a balancing act. We see the tendency, one of the success factors of our Nordic markets and also in the US. In the US, it's been driven by the fact that the lower free float, and that ties into the Listings Act. In the US, you can sell less than 10%. In fact, we don't have a free float requirement at all in the US markets. It's up to the company to meet a certain standard in terms of number of shareholders, but then it's up to the company to decide how much they sell at that particular time. So in fact, the supply and demand question becomes really a driver of the interest and the accessibility. So from that perspective, I think the Listings Act initiative to lower the free float requirement is a good one, because I don't see that the IPO market should be the only one that forces company to sell 25% at a certain point in time. So I think that is a very encouraging aspect. Now, the question of liquidity is counterintuitive, because in the Swedish market, one of the key things that has made our market successful is that we've had the cornerstone and anchor investor mentality. The problem with that is that those anchor investors are not going to sell the share. They're buying for a long-term perspective. So you have an issue there that if the company is not educated in terms of how to create liquidity, a liquidity structure, then they will be faced in the situation that there's no one selling the share, and that ultimately it's the founders that will need to sell, or the management that will need to sell in order to create some liquidity. That also then ties into the Listings Act about increasing the prospectus level, because we are seeing now in Sweden that more companies are doing this distribution of emissions where they're just pushing out shares to retail, and they're doing this without a prospectus requirement. And in Sweden, the prospectus requirement is 2.5 million euros. We haven't increased the level, so we are actually very positive to increasing that level, because it will allow companies to distribute shares to retail in a much more efficient way. Again, the balancing of the regulatory structure for retail. I think it's very interesting that you were saying that at the end of the day, the access to research is important, the access to information, but I'm not sure a prospectus with 90 pages is exactly what retail is going through on a day-to-day basis when they are making an investment decision. So I think it is a balancing act.
You should be more faithful.
We should be more faithful. So from my perspective, we touch and the return of investment. Maybe we should just spend some time more to deep dive on the liquidity aspect. From an exchange perspective, Marek, what are you doing in addition to the research coverage that you mentioned? What are you doing to increase the liquidity or to increase the possibility for liquidity for your companies?
Well, first of all, we segmented our retailers, and those who are really striving for liquidity are on the derivatives market, usually, and they are trading quite actively. Of course, it's a problem known from the cartoon Mitchells against the machines, that it's very difficult to compete by the retailers with the algos, but that's another topic for the discussion. Second thing, what we realized that those who are participating in IPO, and we have quite different challenge to Sweden. You have the well-known problem, which is expressed in French, embarras de richesse. So you have a problem that too much demand and too much capital for the IPOs, and the challenge with for us is that books are not always full, and the companies are left raising like 40, 50, 60% of the intended capital. And what to do is, it's enough to survive, but it's not sometimes not enough to grow. That's why we are building up. Currently, we already signed one pre-IPO or IPO fund. Our subsidiary signed with the which will be focused on agriculture and food tech things, and we negotiate another IPO fund with EIF. So what we need is someone, a kind of a stalking horse, someone who takes over the remaining stake in this company of this IPO book, and this is mainly relevant for our junior market, for our New Connect. And those who are long-term planning, they are long-term oriented investors. They look for returns, and we did a study, or we commissioned a study. The study is quite complicated, but just to simplify the message is that we built a virtual portfolio of all the companies which were IPO'd on our junior market, and we compared with the portfolio of 50+ venture capital funds. And we compared to the portfolio of EIF, European Investment Fund. And basically the finding was that the returns for funds were, VC funds were higher than if you have a portfolio of all companies which were IPO'd on our junior market. But if you were to subtract fees, they were almost on par. It was, the difference was 0.3 percentage points. I don't know which way. It was around 13% per year IRR. So basically what we wanted to show our retail investors is that if they go to the venture fund as a limited partner, so they build a portfolio of our companies, then it doesn't matter that much for their returns, and they have slightly better liquidity on our market than if you are a limited partner in a venture capital firm, in a venture capital fund. And the other thing we wanted to, government helped us a lot a few years ago, 2 or 3 years ago. They introduced a special scheme that if you participate in the IPO, you are exempt from capital gains tax if you keep the shares over 3 years. So it's against the liquidity, unfortunately, but it drives more the investors because they can make extra return from the IPO because they are exempt from that. And on the liquidity side, very last thing, unfortunately, we are very much, our market is very much concentrated around 7 names, roughly. Out of close to 800 listed companies in equity space and 300 another companies in the bond space. So our retailers are perfectly aware of the fact that unless they buy top names, they will have a struggle with the liquidity. So they might be not tempted to put to have large holdings of smaller and medium-sized companies on our venue due to this liquidity constraint. So in a nutshell, I believe that there is the structured market derivatives for those who strive for liquidity, and equity for retailers should be a long-term game. Thank you.
Thank you. Unai, I think that we should maybe distinguish also between the day trader and the long-term retail investor. What is your reflection on liquidity? Is liquidity really an issue for a day-to-day investor that is looking to buy a share on a long-term basis, or is this more of an issue for a day trader? How do you see this liquidity aspect, and what could be done there?
Yeah, from a retail point of view, liquidity is important to have when they need it, even for the long-term investor, because if you want, imagine you have a diversified portfolio and you want it for the long term, but at some point you need to have the money to cover certain expenses. Then you don't need liquidity, but you need to know that it will be there when you need it. So, and for the day trader, of course, there must be liquidity, but even for the long term as well. Here in the Basque Country, we have pension plans, EPSVs, a special kind of pension plans that have the specific particularity is that you can open your pension plan with 18 years, and then when you turn 28, the money that you put today, you can recover it tomorrow. We are not going to do that because you are going to have to pay a lot of taxes. But because of that possibility of liquidity, the amount of money that is being saved in the Basque Country compared to the money that it's being saved in the rest of Spain is much higher. So that's an example of how important the possibility of liquidity is for retail investors to invest. And yeah, I mean, that moves retail investors towards more liquid investments. That means bigger companies,
yes,
index funds, etc. Yeah.
Excellent. Alexandra, do you want to add anything?
Yeah, well, I think it's quite an important point that was made right now. I think the option to have liquidity is quite important, but I think the majority of our membership, so the members, individual members of our member associations, are really looking for long-term investments, really, and they also save for the long term. And so maybe to come back a little bit to the topic of the cost, because I also hear quite often when we discuss retail investment strategy that the current proposal is too much focused on cost. But also to quote Professor John Kay, who is saying, and I agree with it, that the least risky strategy for retailers to improve the returns is to pay less to the financial industry. We should not underestimate the cost for the retail investors, and it is a very important point. And also the study that we have made three years ago about the correlation between cost and performance of investment funds. The conclusion was pretty clear that quite often, the more you pay, the less likely you're going to get. So it's not really that the more you pay for the financial product is going to get you a higher financial return. So I think this is also important to remember. And I really think that a very good element that maybe is overcomplicated in the proposal of the European Commission, but the concept is really good and should be finally implemented in the EU, is the value for money, so that the investors really know that they get the value for the money that they are paying for financial products, and this is still not the case. And maybe one final point, because from what we are discussing right now, it may seem that really retail investors are irrational, that they are investing in underperforming products where they should maybe invest really in capital markets and get better returns. The problem is that, as the studies done in the last years show, the majority of retail investors in the EU are relying on bank advisors, and those almost never advise them to invest directly, also not in cheaper products. Usually the advice is given for quite complex and quite overlayered products with many layers of fees. So I think that the financial education for retail is quite important, as I said already, but I think also the education of financial advisors is equally important right now.
Yeah. I was talking to a bank the other day, and they've applied the philosophy that they can't sell what they wouldn't buy themselves. So maybe that's one way of measuring value for money.
80% of the product portfolio.
That's the challenge. But no, I agree. I think when we touch upon financial literacy, we as an exchange in the Nordics are focusing a lot on the derivative side to explain to retail investors the value and the efficiency of diversifying your portfolio with retail. But I think equally important, the financial literacy really has to go down through the whole value chain. And I think maybe there, from that perspective, one is regulation, but the other one is also to make sure that the definition of value of money is really to be able to keep your customers over a longer period of time. with credibility. But Jesus, maybe something from your end on.
Well, what is clear is that more regulation doesn't mean better regulation. And we've got this with the research, for example. The number of companies with research right now is much lower than prior to MiFID because of the unbundling of commissions. It led to a lot of entities stopping covering a lot of companies and going back to the previous place where we were prior to this rule from MiFID. It's very, very difficult. Also, there are some initiatives. There are several initiatives in Spain, for example. We are trying to do sponsored research, but the truth is that liquidity is completely key, and without research, the liquidity dries. That is very, very clear, and there are a lot of different points that affect liquidity. For example, the market abuse regulation leads to less liquidity. Of course, abuse should be forbidden, should be prosecuted, but the problem is that too strict rules leads to less liquidity. And for example, at least in Spain, the supervisor is very focused on supervising the maximum amount in stocks with very low liquidity because it could affect to the daily liquidity valuation, and this leads to all these asset managers not to invest in this kind of companies. So it is a very complex issue, but a lot of points should be tackle in order to increase liquidity.
That's a relevant point. I think from our perspective in the Nordics, what we're going through right now is that one of the fundamental backbones of our IPO success has been the participation of smaller microcap funds that have been willing to allocate smaller amounts of money to support growth companies from an institutional perspective. And of course, their customers are retail to a large extent that have invested in these funds, but now there is more and more restrictions on these funds that they cannot invest if they don't feel that the investment is a liquid asset. So from that perspective, there's more scrutiny on that investment opportunity. That will also make sure that probably they will avoid to make that investment, or at least will need to think a lot more carefully before they make that investment to a smaller microcap company, because with the risk of the increased requirements from the regulator and also overall the position that they can't get out of the position without damaging the outcome for the company as well from a share perspective. So I think when we talk about liquidity, we often talk about it from a retail perspective, but it's, I think, equally important, or if not more important, is the liquidity for institutional investors. And the other aspect on liquidity is we're now faced with a lot of discussions with private equity that see the IPO market or the public markets as less liquid, and therefore the ability for them to put a company on the exchange, and then the ability for them to exit as an investor because they're not a long-term public market investor, becomes very complex. So rather than putting the company on the exchange in a less liquid environment, they tend to keep on to these companies for a longer period of time. So again, liquidity is a very broad topic, but it is a very important topic. I think liquidity for retailers is both passive and active. But I think also it comes down to liquidity on the institutional side, because at the end of the day, we're seeing a trend that more and more retail investors are participating in the markets in a passive way. So from that perspective, it's important that these funds get exposure to smaller, mid-sized companies where a lot of the growth is. And then ultimately, I think from a liquidity perspective, I think maybe I look at it from an exchange perspective, maybe this ordinary trading environment is not always ideal for a company with a very controlled ownership where there's not that much liquidity. We're exploring now an auction-only model, which potentially allows us to concentrate liquidity in a better way, which allows for a better price formation. But one thing that was mentioned before is the advice and financial literacy, as we were touching upon. What is it that could be done there? Because it seems like the suggested proposal is a bit weak in terms of what can be sort of, it's a very tough topic, but is it something that you feel, it's a balancing act between how much we regulate, but at the end of the day, we want to create confidence in the public markets. Is there, like very quick, do you feel that when we talk about advice, we talk about incentives, is there anything specific that you feel they should really address on? I think there's also the proposal to reduce the investor categorization, allowing companies, allowing a professional investor to be a professional investor with only 250,000 euros compared to 500,000 euros. What is a proposal there from your perspective that could help?
Well, in my humble view, you can, of course, get the regulation more and more precise, more scrutiny and so on, but at the end you might discourage people from investing. Of course, it would be extremely safe environment for the retail investors if there were no retail investors on the public market. So basically, it's taken, to my understanding, to kind of absurd. What we observed, at least in Poland, and Poland was 6-7 years ago at the bottom of the chart of OECD countries when it comes to financial literacy, really competing for the third or second or slot from the bottom. And we improved to the, let's say, OECD average in terms of financial knowledge and ability to use this knowledge, so it's called skills, yeah. And the skills, and what happened actually, it's not because we've done a lot of educational programs or something like this, but simply we are the outgoing government introduced default but not compulsory pension funds. So people were by default enrolled, but they had to opt out. And of course, when it comes to money, people are very much interested in what's gonna happen, so they had to take a decision if they stay in the system, knowing this bad but past experience from a few years ago with the dissolvement of the compulsory pension fund, or they quit. Yeah, and it was a major reason, and plenty of asset managers and plenty of institutions started to teach people, to make them stay in the systems. There were we were offering trainings, for example, for trade unions, so we can explain them how the public markets work. So this was a national exercise how to do the finance, right? And it was, and now we improved a lot. The problem, the category where we have not improved yet is the attitude to finance. So how we have attitude to savings, to consumption, and so on, long term, and that's why we have currently the opt-out was used by majority of the people. It started like 70% to opt out from the system, now 60%, and in recent rollout it said that it's around 50% opted out. So still people don't want to go there, but the major thing is, major reason for that is that people do not want to sacrifice their current consumption against the future benefits from this pension system. And I even made to the headlines when I said that we should teach finance at the courses of ethics at religion in school, not in business course or whatever, because the issue is that people should understand what is what is the meta attitude to their life, if they want to spend everything they earn or they want to put some money aside, and that's the crucial thing. So I will not limit that much access to the market for the retailers. I don't believe that much in the teaching people to swim in the empty pool. I believe in learning by doing, by experimenting, and there are good experiments, bad experiments, but people learn that. But we have to fundamentally change attitudes towards how we save and how we go around our money, and this is a meta problem, not a technical problem.
Thanks, Marek.
Thank you.
So I think the journey that Poland has done is quite exemplary, and I think from your perspective, it is ultimately empowering the people, and I think that's where we've seen in the Nordics, we've seen that the return that the engagement in the public market has really given. The public pension system would not have covered that wealth that has been created by the individual by being engaged in the public markets. We have a few minutes left. Let's just take a quick round if there is anything that you feel the Commission should be focusing on compared to what they have done so far, and what are the sort of two key takeaways, or one or two key takeaways that you would like the Commission to engage with in the next round? You and I, we start with you.
Well, the first one would be, it's a general comment, but please simplify regulations. Every time that I see a new regulation and it has like 100 pages, it's I always think that it could have been done shorter. So it's please try to summarize, because now afterwards asset managers as ourselves we have to apply all that, and it's very, very difficult for us to to keep track of all that regulation that keeps coming. So we are in favor of regulation, but it should be shorter and clearer. That's the first one. The second one would be to try to pass some kind of incentives for people to invest earlier, even as kids. I don't know how to do that, but I think that the best way to learn something is by doing and by seeing. And when you are a teenager and you have your father has invested for you 3,000 euros, you have seen ups and downs, and then when you are older, you have already seen that, and you can, you have seen the benefits of investing and not saving.
That's two good, very advice. Thank you, Yuna. Alexander.
So I would still say access to unbiased advice, independent advice for investors, concept of value for money, and implement and enforce it, but maybe simplify it a bit. Look what the UK FCA is doing with value assessments. And retail investor education, yes, at the very early stage. I support what the colleague just right now said, but also please also look at the employee share ownership. We've been saying this as Better Finance already for a long time. Also look at it as the Commission as one of the possible education tools for retail investors.
Thank you.
I would say that to take into account taxes, because it has no sense that commissions wants to be reduced and Tobin tax is introduced, that it could be 3 times the commission received by the broker. And they try to make explicit commission instead of implicit commission, and they do not take into account that you have to add value-added tax to this commission, and it is not deductible from the capital gain. So it should be coordinated with the tax in each country.
Excellent. Marek, maybe something you want to add?
I was saying a lot, so just simplify the access of the good companies to the public market, and the retailers will do their job.
Yeah. Well, thank you everyone for a great contribution. I think in summary, simplification, regulation is good, but simplify it, make it clear, concise. Engagement, get people to learn by doing. I like the engagement piece related to options and related to making sure that it's easy for employees to take risk and to get rewarded for risk. I think option taxation across Europe and the way it's structured is counterproductive, and therefore that's also one way the US has a way to compete, because ultimately it's this engagement that they're able to roll out in an efficient way. I think literacy is important, literacy about from day one, to make sure that it's also not theoretical but also practical, but really looking at making sure that they understand that return of investment is not over day, but it's a long-term investment that is taking place, and there will be a return. And then ultimately access to the markets. There should not be too much focus on just cost. It should be really making sure that there is a return of value, and that means that everybody has to be engaged there in defining what that value is. So thank you very much, and thank you for your contribution.
Well, thank you very much. I think a day full of many insights and reflections that I think are very valuable. Thank you to all the listeners that have followed on the internet, the web stream, and we will also make the recording available, because I think those kind of discussions are important right now to really frame a little bit what will Europe do. And in that sense, really thank you to all the speakers, the panelists, our two moderators, Adam and Rosa, to make this happen and to put this together, but also to our kind hosts from Beatriz Alonso, Jesus Gonzalez, and Manuel Ardanza from BME6. We heard from Tatiana Panova about the Listing Act, the important CMU work that the Commission is doing. We have, I think, delved a bit into what else needs to be done on the primary market side of the EU to change paradigm. And I think what we heard is a little bit really reduce the burden for issuers, make the market slimmer, make it more efficient, the need to simplify, to reduce burden, to harmonize, to be smarter, to think small. I think I also heard a lot of that resonate here, but certainly on the second panel, and I think it was also in the speeches in the morning, the need to activate institutional and retail investment, where the retail investment strategy really can be only a first step to increase the participation in capital markets. And I think really to get more investors is key to revive, democratize our markets, to educate, to incentivize, to get people to invest in the long term. I think we all heard it right now. When I take a bit of a step back and really look at this, I think, you know, we are at a crossroads probably at this point. Yes, the digital and sustainable transformation will require huge amounts of capital. The EU is predicted to need around 330 billion a year only to reach the climate and energy targets, another 125 billion a year for the digital transformation. We live in a world with higher defense spending, higher interest rates that put stress on public finances, that give governments less room to also intervene in the economy as they did in the corona times and maybe after the financial crisis. We live in a world where banking is simply scarcer, or bank financing is scarcer due to higher regulatory hurdles, to higher capital requirements, as well as more expensive due to interest rates. And certainly capital markets play an important role, and I think that's something we always preach, but I think it's always good to remind us capital markets are there to provide equity that is a wonderful buffer against exogenous shocks. We heard today, yes, the US does have higher valuations and higher liquidity. It's providing a draw for innovative companies. Yes, we live in a complex and fragmented system of insolvency law, corporate law, different tax systems, and many other areas where international investors perceive Europe as simply complex and as not that attractive. So really there is agreement, and I think that's a little bit the sum I would draw from today. We need a deeper and more attractive EU-wide capital market. We need to think how to be more competitive and to provide end investors with more choice for their money at lower cost, better growth opportunities for fast-growing enterprises, and ultimately, I think, have less volatile markets. It's also fair, and I think that's why I say we're at a crossroad. We're not there. We're not delivering a market capitalization to GDP, and we started to track that about 10 years ago in the first FESE blueprint that we did. Was around 85% of market capitalization to GDP. Well, in 2023, The US was still at about the same number. I think we had 180, I think 10 years ago. They're now second quarter of 23 at 177%. We've come down from 85 to 65. And yes, there's maybe some cyclical things in there, but I think there's a lot of structural problems in why this figure has not gone up. It's come down 20 percentage points. If we look, and we've discussed that today, portion of household financial assets in financial securities in the US, 41%. So almost every second US household is somehow invested. And when I was a kid, when I was 15 years old doing an exchange in the US, finance was discussed at the dinner table. In the EU, that figure is 16% of households that own financial assets, so certainly a different parameter. And we can discuss as much as we want, and I think it was an extremely rich discussion that the CMU is multidimensional, listing, trading, access, multi-jurisdictional with insolvency law, corporate law, and all the issues that are out there. But I think we need to be blunt in the next Commission's term, and I think also member states need to be blunt when we're really seeing that companies are moving to the US. That ultimately means, and you know, it's a first voting by the feet that is happening, but I think it also means, of course, losing the innovative potential of companies here in Europe. It ultimately means that probably company seats are moving away from Europe, and that certainly is something that would impede growth and employment and ultimately the tax base. So I think member states should care. We risk losing the capability, obviously, of financing ultimately our own economy if that would be to continue. So I think we should have a strong interest to look how to change that. And we heard, I think today, we risk leaving our citizens very ill-prepared for what is coming with a demographic challenge and where pension systems of governments will not be able to pay out. So I think the last panel and Adam saying that, you know, the Swedes have made that transition. I think other countries need to really be able to do that as well. So I think we heard, I think throughout the morning, we don't have any time to lose. We need to act. Member states need to act. The Commission needs to act. We need a sense of urgency. And I think that I sometimes feel in those political discussions is missing. We seem to be thinking of long-term action plans. No, we need to really think what to do to push to overcome the fragmentation and complexity and to empower really significant institutional and retail investment into our equity markets. Let me close again with a big thank you to 6BME for hosting us, especially Pila and Anna, helping so much behind the scenes, Marian and the entire FESE team, and let me invite you to a lunch on the floor of the Bilbao Stock Exchange. That is one thing that the people only watching on the internet will miss. Thank you.